everyone! It appears the wild summer rally on Wall Street has come to an end. The latest events significantly undermined optimistic sentiment. Last Friday, the US stock indices plummeted markedly, losing all their August gains. Over the week, three major stock indices have dropped by more than 4%, logging the second weekly decline in a row. Investors were pinning their hopes on a shift to monetary easing, but it did not happen. They had to accept the fact that the Fed would stick to a hawkish stance in the long term. The tone of Jerome Powell's speech at the Jackson Hole Symposium was rather hawkish. What's more, traders believed that stocks could escape a bearish market rally, expecting the Fed to move from aggressive tightening. The new week kicked off on a negative note as well. Investors are now looking for clues by assessing fresh macro stats and other news. The main highlights of the week will be the speeches of Fed policymakers, the non-farm payrolls report, and the ISM manufacturing PMI. Volatility may increase in the coming days. There could be sharp swings on Wall Street as speculators should revise their expectations for key rates, which have coincided with the ongoing trend. Watch this video till the end and leave your comments down below. Let's start. The rally in the equity market is over. The sell-off risk assets have been going on since the start of the week. Prior to the symposium, the majority of investors were expecting hawkish rhetoric from the Fed. Besides, Fed policymakers also made rather hawkish remarks before the meeting at Jackson Hole. Speculators had to accept the brutal truth that the monetary tightening would remain in force. However, there was a faint hope that the opposite scenario could take place, as traders considered Powell to be a dove. For this reason, they reckoned that the Fed chair would provide hints about a slowdown in monetary tightening. The main argument was that inflation seemed to have peaked. Yet the expectations turned out to be false. Powell was quite laconic. In his testimony, he summarized the facts his colleagues had already outlined in their speeches before the event. So he simply confirmed their words. In his keynote speech at Jackson Hole, Powell pledged to lower inflation by keeping high interest rates for a longer time. The historical record cautions strongly against prematurely loosening policy, he warned. Powell also advised traders to take with a pinch of salt the latest report showing a slowdown in inflation. The Fed's focus is broader than a month or two of data. The regulator will continue pushing ahead until inflation moves down closer to its 2% long-range goal. It could adversely affect economic growth. However, failure to restore price stability would mean far greater pain. So the Fed will maintain a hawkish stance to rein in inflation. Traders who were counting on a softer policy had to abandon their hopes. Wall Street experienced a steep decline last Friday. The Dow Jones plunged by 1,000. Its weekly losses exceeded 4%. Investors are now reviewing their expectations, factoring in a gloomier scenario like a recession. On Monday, stock markets were still gripped by bearish sentiment. Such a market reaction is quite explicable. Investors are concerned about the impact of higher interest rates on the economy. The Dow decreased by almost 100 points on Monday, while the S&P 500 slipped by 0.3%. The NASDAQ lost 0.5%. These were the worst sessions since June. However, it's hard to say what to expect in the future. This week is rich in events. Fed members are scheduled to deliver speeches, yet traders are likely to ignore them. Powell has already said that the Fed is focused on the economic reports, so investors will do likewise. Now they are awaiting the non-farm payrolls report, which is on tap on Friday. If the figure is negative, a downtrend may intensify unless traders find some reasons for optimism. Given recent events, there are none on the horizon. The watchdog is highly likely to raise the key rate by 75 basis points in September. The revised GDP data revealed that the economic slowdown was not so significant. Corporate earnings for the second quarter rose considerably, signaling low odds of recession. Weekly jobless claims also declined more than anticipated. However, it's necessary to wait for the NFP report. Analysts expect the NFP data for August to be upbeat. According to Bloomberg forecasts, the number of people employed in the non-agricultural sector increased by 300,000 in August. The S&P 500 index also saw a sharp weekly decline. It took a nosedive by 3.4% last Friday. Traders used to sell off shares after such a drop. Given the current fundamental background, stocks are likely to slide lower. The question is which lows shares could hit within a downtrend this time. Analysts recommend focusing on the June lows. Earnings reports and forecasts and the optimism that the Fed may engineer a soft landing have lifted the S&P 500 index by about 13% from the mid-June lows. September will be a gloomy month for stocks. However, the future prospects are not so grim. On the contrary, the benchmark indices, in particular the S&P 500, are projected to finish the year in positive territory. According to a recent Reuters poll, their index will end this year at 4,280. A more optimistic forecast suggests an increase to 4,350. Next year, the index will continue to grow, reaching 4,400 by the second half of the year. For now, the S&P 500 is overbought territory. The market price is probably 3,950. Given mounting uncertainty over the economy, inflation, and the timing of monetary tightening, the S&P 500 could drop to 3,620. Only one thing is clear: volatility will persist. Stock movements will depend on momentum as well as fundamental factors. The heavy tech NASDAQ 100 declined by more than 4% last week. Its Friday decrease was 3.9%. The tech giants suffered the sharpest losses, closing at monthly lows, with Nvidia shares falling by almost 9% and Alphabet stock dropping by 5%. Despite a pessimistic outlook for at least 1 month, the light at the end of the tunnel is visible. Analysts believe that the equity market has finally bottomed after its steep fall in June. Another test of the previous lows is possible, yet stocks will hardly approach new ones. The Fed is not going to raise rates more aggressively. Signs of a decline in inflation have appeared. The labor market may soon begin to weaken. If so, the regulator is likely to refrain from extremely high rates. However, one cannot be completely certain. The probability of a recession next year is 50-50. It's difficult to say whether the Fed will raise rates aggressively given such a scenario for the economy. Therefore, traders hope to get clues from the speeches of Powell and his colleagues about this issue. Recent earnings reports have facilitated a rise in stocks. Nevertheless, analysts' estimates of annual profit growth have declined slightly since the beginning of July. Investors are puzzled about whether earnings will be able to grow fast enough to boost shares. That's all for now. Subscribe to our channel and keep close tabs on market developments. See you.